Namaskar dosto, welcome back to Dhwaj Stock Info. Today we are going to discuss one important subject that the complete company analysis live, the balance sheet and profit and loss account, cash flow and all the 7 FA checks. All the 7 FA checks, one company, one picture. For 14 episodes and 26 shorts, I have been giving you the tools. Episode 11, the 7-point framework. In episode 12, how to read the balance sheet. In episode 13, how to read the profit and loss statement. And episode 14, how to read the cash flow statement. 7 FA ratio shorts from ROE to dividend yield. Today in episode 15, we use all those tools together on one company, live, step by step, number by number, even red flags checked, every green signal is confirmed. This is what separates an investor who buys on the tips from one who buys on the evidence. By the end of this episode, you will be able to run a complete 30-minute company analysis yourself for any company, completely free on screener.in. That is my promise to you today. I request all the viewers to please watch the video in full without skipping to get full information on the analysis and to update your knowledge. Let us start the video. The 10-step analysis framework. Screenshot this. Checklist. Step 1. What do you want to check? Understand the business. What does it sell? Where is the source? The company website and the annual reports and the screener.in description. Then, in the step 2, what you want to check? Revenue 5 years trend, growing 15% plus. Source, screener.in, profit and loss tab, sales row, 5 years view. Then in the step 3, what you want to check? Profitability, 3 margin plus EPS growth. Source, screener.in, P&L tab, episode 13, 3 margins. Then the step 4, what you want to check? Balance sheet, current ratio, D reserves. Source, screener.in, balance sheet tab and episode 12 checks. Next, step 5, what do you want to check? Cash flow, OCF versus PAT plus FCF. Where is the source? Screener.in, cash flow tab, episode 14 checks. Next, step 6, what do you want to check? ROE above 15% for 5 years. FA check 1. Where is the source? Screener.in ratios and chart 20. Then in the next 7th step, what do you want to check? DE below 1. FA check 2. Where is the source? Screener.in ratios and in chart 21. Then the step 8, what do you want to check? Promoters holding stable, no pledging. This is financial analysis check 3. Source, screener.in, shareholding, short number 23. Then step 9, what do you want to check in step 9? PE plus PEG ratio versus sector. This is FA check 4. Where is the source? Screener.in, ratios and in chart 24. Then step 10, what do you want to check? PB plus dividend yield, FA checks 5 to 7. The source, screener.in ratios, chart 25 and chart 26. Then in the next section we'll discuss now PL and analysis, step 2. Step 2, revenue trend. Our education example company shows revenue growing from 1 lakh crores to 5 years ago to 1 lakh 60 crores in financial year 26, approximately 10% CAGR, consistent and predictable for large companies serving Fortune 500 companies. 10% consistent growth is genuinely strong. Note, if that financial year 26 growth showed 9%, we will investigate in step 3, profitability, EBITDA margin approximately 26%, stable over 5 years, net margin approximately 18%, EPS grow from 95 to 140 over the 5 years, approximately 8% EPS CAGR. In financial year 26, contrast in infrastructure, office space, PAT up by 1.6% shows revenue growth and profit growth together. Hitachi Energy revenue grow, all the margin disappointed. Our example shows both revenue and margin stability over the 5 years. That combination is genuinely high quality. P&L account summary table, education example only, not real figures. We'll go step by step now. What P&L metric, revenue, rupees in crores, financial year 22, 1 lakh crores, financial year 23, it is 1 lakh 15,000 crores, in financial year 24, it is 1 lakh 30,000 crores, in financial year 25, it is 1 lakh 47,000 crores, financial year 26, that is estimated, it will be 1 lakh 60,000 crores. Then the second metric, revenue growth percentage. In financial year 22, we see nothing because it is starting point, and financial year 23 it is 15%, and in financial year 24 you can observe it is 13%, in financial year 25 it is 13%, and in financial year 26 estimated to be 9%. Comparatively, this is very low. Please observe here. Then the P&L metric, EBITDA margin. In financial year 22, 27%. In financial year 23, it is 26%. In financial year 24, it is 26%. In financial year 25, it is 25%. Financial year 26, it is 26%, that is estimated to be 26%. And the next P&L metric is net profit, rupees in crores. Financial year 22, 16,500 crores, and in financial year 23 it is 19,000 crores. In financial year 24 it is 21,500 crores. In financial year 25 it is 24,000 crores. In financial year 26, it is estimated to be 26,000 crores. Then the next P&L metric, net margin. We shall see the net margin for different years. Financial year 22, it is 16.5%. Financial year 23, it is 16.5% again. And financial year 24, it is 16.5% consistent. Financial year 25, 16.3%, financial year 26 estimated to be 16.3%. Then the next P&L metric, EPS rupees. For financial year 22 it is 95 rupees. For financial year 23 it is 107 rupees. Financial year 24 it is 120 rupees. Financial year 25 it is 132, and financial year 26 it is estimated to be 140 rupees. Then here you have to observe the green, revenue growing, margins are stable, EPS are growing, monitor 26 revenue growth showing to 9% only, industry cycle or structural. Now here what we have to see is balance sheet and cash flow coming next, confirming whether the P&L profits are blocked by the real financial strength. The complete picture only emerges when all these three statements are agreed. In section 4, now the balance sheet analysis, that is the step 4 thing we have to discuss. Balance sheet, the framework from episode 12 applied. 3 key checks, current ratio approximately 2.4, above 2%. The company covers all the short-term obligations comfortably. Debt to equity ratio approximately 0.1%, essentially debt-free. The asset light business model advantage. No factory loans dragging down the balance sheet. Reserves growing from 80,000 crores to rupees 1,30,000 crores over the 5 years. Consistent shareholder wealth is building, zero negative equity, zero excess goodwill. This balance sheet passes every red flag check from episode 12 with the flying colors. Then the balance sheet check here, current ratio. The example company is approximately 2.4. The episode 12 benchmark above 2. That is the fortress pass always. Then the next balance sheet check is debt to equity ratio. In the example company, we see approximately 0.1% debt free. Episode number 12 benchmark below 1 is good, near 0 is excellent. Then the next balance sheet check, reserves 5 years trend. In the example company, we see rupees 80,000 K to 1.3 lakh crores. Episode 12 benchmark growing every year is equal to shareholder wealth is building. Next balance sheet check, negative equity. In the example company, we see no, it is not. Then in episode 12 benchmark, walk away if yes. Episode 12 red flag 1 always. Then in the next section we discuss how cash flow analysis. Step 5 cash flow analysis. The truth test from episode 14, operating cash flow approximately rupees 28,000 crores against the net profit of 26,000 crores. OCF is constantly above the net profit. The gold standard confirmed every rupee of reported profit is backed by more than a rupee of a real cash. Investing cash flow approximately negative rupees 8,000 crores. The company spends technology infrastructure from its own earnings. Free cash flow OCF is 28,000 crores minus capex of 8,000 equals 20,000 crores. Free of cash flow, the holy grail from episode 14. This 20,000 crores goes from shareholders through dividend and buybacks every year. Financing cash flow negative. The company repays whether the little debt exists and the pays dividend simultaneously. This is the picture of complete financial equality. The cash flow summary, education example only. Operating cash flow, financial year 2026, approximately rupees 28,000 crores. Cash flow summary versus net profit from profit and loss account. Financial year 26, approximately rupees 26,000 crores. Cash flow, next cash flow summary. OCF, above PAT, gold standard confirmed. Financial year 2026, approximately surplus of 2,000 crores. Cash flow summary, next cash flow summary is investing CF, technology, infrastructure, capex. Financial year 26, approximately rupees minus 8,000 crores. Next cash flow summary is free cash flow is equal to OCF minus capex, the holy grail. Financial year 26, approximately rupees 20,000 crores. Cash flow next cash flow summary is cash flow verdict exceptional, all checks pass. Financial year 26, approximately all green. Now here what we have to observe is the 7 FA ratio checks are coming now. Every ratio from short 20 to 26 applied live. This is the payoff for the entire short series. Section 6, all 7 FA checks. Go through each FA check from the shorts without fail. Now, the heart of the analysis, 7 FA checks, all from the shorts. I open ratio section on screener.in, ROE from short 20, debt to equity ratio from short 21, operating cash flow confirmed, promoter holding from short 23, PE ratio from short 24, price to book from short 25, dividend yield from short 26, 7 checks, 7 minutes, the complete quality and the valuation picture that one single ratio can provide. Now we will see the FA check, ROE short 20, example of finding approximately 28%, the benchmark above 15% for 5 years. What is the signal? It is green. Next FA check, debt to equity ratio from short 21, example finding approximately 0.1%. The benchmark balance below 1.0 is equal to safe, near 0 is fortress. The signal is green. Then the next FA check, OCF versus PAT from short 22. Example finding OCF above PAT. Benchmark OCF above PAT is equal to gold standard. What is the signal? It is green. Then the next FA check, promoter holding from short 23. Example finding 13% stable, no pledge. The benchmark 13% low but stable. Context matters. Signal, monitor always. Then the next FA check, P ratio from short number 24. Example finding approximately 22x, that is 22 times. Benchmark IT sector average 25 to 35, below average. The signal is very attractive always. Then the next FA check, price to book ratio short number 25. Example finding approximately 5 to 6x. The benchmark IT sector nominal 5 to 12, within the range. The signal is fair. Then the next FA check you have to look for, Dividend yield from chart number 26. Example finding approximately 2.2%. What is the benchmark? 2 to 6% income zone. Payout 50% sustainable always. The signal is green. Now the promoter holding, most sophisticated part here. The 13% promoter holding needs context. The original founders exited decades ago. The company is now owned by the world-class institutional shareholders, top global fund managers, and crucially, the holding has been stable for years with zero pledging. In short 23, we learned the key question is not just the level but the trend. Stable holding with zero pledging and institutional quality shareholders is not red flag for this type of company. This nuanced contextual analysis is exactly what separates experienced investors from beginners. You do not apply the same template blindly for every company. Context always matters. Next, in the next section, the complete 10-step scorecard I will give. Screenshot this table right now. Most valuable graphic in the series. Here is the complete scorecard, 10 checks, clear results. This is the analysis you can now do yourself for any company in 30 minutes, completely free on screener.in. The complete 10-step scorecard. Screenshot this table right now. We'll go one by one. Analysis check. Step 1. Business model. Where is the source? It's in the annual report. You have to check the annual report. Findings. Assets, light IT services, predictable dollar revenue mode. Result is mode. Then the next analysis check. Step 2, revenue growth. Where is the source? It is in the profit and loss account tab. What is the findings? 10% CAGR 5 years, consistent, showing 9% FY26. Monitor, result. Pass. Result is equal to pass. Then the next analysis check. Step 3, profitability. Where you will find the source is in profit and loss account tab. The findings. Net margin is 18% stable. EPS CAGR 8%. EBITDA is 26%. What is the result? It is pass. Then the next analysis check. Step number 4 is balance sheet. This is very important. Where is the source? The source is in the balance sheet tab. What is the findings? Current ratio 2.4, debt to equity ratio 0.1, reserves growing, clean always, result pass. Then the next analysis check. Step 5, cash flow statement. This is very important. Where is the source? The cash flow tab you have to check always. Then the findings. OCF above PAT. FCF rupees 20,000 crores. Financing CF negative. Result is pass. Then the next analysis check. Step number 6, ROE short 20. Where is the source? Ratio tab in screener.in. What is the findings? Approximately 28% consistently, well above 15%. Benchmark always. Result pass. Then the next ratio, the next analysis check. Step number 7, debt to equity ratio from short 21. The source is ratio tab again. Findings. Approximately 0.1%. Debt-free fortress balance sheet. Result. Result is equal to pass. Next analysis check. Step 8. Promoter short 23. Source. Shareholdings. You have to check in the screener.in. What is the findings? 13% but stable. No pledging. Institutional quality shareholders. What is the result? Monitor always. The next analysis check. Step number 9. PEG. PE plus PEG ratio from short 24. Source is ratio tab. Findings. PE approximately 22 times versus sectors 25 to 35. Below average attractive. What is the result? Attractive. Next analysis check. Step number 10. PB plus DY short from 25 and 26. The source is again the ratio tab. Findings. PB ratio 5 to 6 times, justified by 28%. ROE DY 2.2% sustainable. Then the result is fair. Overall 8 to 10 checks, green, 2 monitor, 0 red flags, education example only, not a investment advice. Verify actual current data on screener.in, consult semi-registered advisor before taking any investment decision. Then section number 8, what to monitor, call to action now. The most important section, lesson of this series. Before I give you action steps, the most important lesson from this complete analysis, when you look at P of 22 times alone, it looks cheap. But when you combine it with the revenue growth and showing 9%, you ask a deeper question. Is this a temporary industry cycle or a structural change? The balance sheet and the cash flow both confirm the fundamental health. The OCF above PAT confirms the profit are real, but slowing revenue growth and the promoter holding level are two things to watch closely every quarter. This is what complete analysis looks like, not a binary buy or sell, the genuine understanding of what you own and what you watch. 4 action steps today. Step number 1, open screener.in, pick any company you own, run all the 10 steps. Step number 2, check the P&L first. Is revenue growing and margin stable? Step number 3, cross-check cash flow, the OCF above PAT. Then step number 4, run the 7 FA ratio analysis. How many are green? Comment in the company name and your score. I reply to every comment every day. Episode 16 is coming. Keep following every single day. Please subscribe, like, share with family and friends. Please support in order to bring more and more such good videos free for you. And thanks for watching.